Thanks for tuning into BQ Conversations. I'm Neeraj Shah, and we are, well, not exactly at the start of the year, but if you can allow me that leeway to call this as a start of 2023, it's just the perfect time to talk to the head honcho of the largest brand in the industry currently in India and arguably in a lot of parts of the world, to talk about how the hotel and the hospitality industry could shape up, not just in 2023, but going ahead. The fact that we are doing this on the back of an extremely strong set of quarter 3 numbers only adds to the luster of the conversation. Mr. Puneet Chhatwal joins in right now to talk about that. Puneet, great having you. Thanks for joining in.
Thank you. Thank you.
So I want to start it off with a 50,000 feet view. It seems that post-COVID or post-2020, there's just been a sharp, consistent turn for the positive. You reckon the industry has changed in many ways from what it was for a better part of the last decade or the last couple of decades?
Very interesting that you felt that way because it's quite true.
Mm-hmm.
So, one thing which has changed in the industry globally is the view on the cost. So, your fixed cost base has become more variable, and the variable costs are under check despite the inflation. So, when companies come and report the results, the revenue increase to the profit increase sounds a little bit disproportionate. So the conversion levels have gone up. That's one. The second thing which has changed in the sector is that you're more focused today as a consumer on your national brands because they became the safer places. You went where you knew what you were going to get. So I think in almost all countries, the national brands became a preferred way forward. The third thing that changed is the consumer itself. The consumer, base was firstly only domestic. International travel was shut, and it was quite obvious that the first trip people took on their own, without a driver driving them or without them able to fly, was they started driving on their own with the family, which was a tough decision. The second time, it was a less tough decision. The third time, it was a relatively okay. And thereafter, it became easy. So more and more people are traveling now on extended weekends, whether it was the Republic Day weekend with, 1 day of working in between. So I think this as a third element, the change in consumer behavior is very strong. And the sector, especially in India, has seen an upswing without having even 50% of the base of the international travel and without G20 getting into full swing and the other events that are expected to happen this year, like the World Cup cricket. So a lot of good is yet to come. So I do believe the change is sustainable. I do believe the change will drive profitability. I do believe that the best is yet to come.
Mm-hmm.
With just one caveat: talent. A lot of talent migrated into other sectors because people were inculcated with the fear that if you go to a hotel or restaurant, you might get COVID-19. So a lot of people left. There are many other players who kind of furloughed the staff. We heard this term, at least I heard it for the first time in my career. We were blessed; we didn't go that way, but talent is the other challenge in the post-COVID era, and how we are going to skill people and skill a lot of people, and that is actually also something very exciting.
Okay, and I'm going to talk about that as well. But first, how much of this? I'll come to 2023 also. But how much of this do you reckon could stay for a better part of the decade? The shift in fixed versus variable costs. In your experience, the ability of the customer to spend a lot more on experiences and less on products, if you will, and if that is driving this behavior of extended weekends and just a lot more leisure time versus what maybe used to happen in the past. How much of this do you reckon is sustainable well beyond the initial post-COVID reflex action, if you will?
A lot is sustainable, and experience travel is not, or experiential vacations is not something new. That's been there. What has changed is combining business and leisure in a way that it never happened before. So, because of the switch to digital, because of the possibility of having video conferencing, it was there before too. But the amount of people who moved on to Zoom and Microsoft meetings, calls, and are still using that very effectively, that is a change that will stay to a major part. But a lot of meetings will also become physical because relationships cannot be built on a screen. You have to meet the people like we are meeting now and having this chat. So I think for a short term, a year and a half, it was fine. But ultimately, especially hospitality is a relationship business, and we can't serve customers digitally. We can use an app to send food at home, but still somebody has to bring the food home. Right? So I think some of that is there to stay. But the most important factor is on the Indian subcontinent, let's say even India, the supply is constrained because not many hotels went into the development phase in the last 3 years. The demand is coming back very strong on the domestic front and is still going to go up because of the international travel that is started. And for us, that travel is more important between October and March because that's the time the climate is very conducive, especially for people coming in from the West. So I do believe that this is going to be a sustainable, profitable journey for the sector. And also, people are beginning to enjoy more. People are beginning to value after seeing what happened during COVID. Some people like to call it pent-up demand, but it's now almost 1 year since the third wave. I don't think pent-up lasts for that long. It's a change in the customer attitude and in the consumer behavior.
Most certainly. So, in a manner of speaking, if indeed the domestic traveler continues, I mean, economy growth permitting, continues to spend as much as she or he has been doing for the last, let's say, 12 months or 18 months, if international travel comes back with a bang, not just because of G20 or events like the World Cup, but even otherwise, and if supply is not coming up at the same pace, am I to believe that for the industry at large and for you, occupancies, ARRs are metrics that will only keep on going up? I shudder to think that the ARR can move up further, but I'm still asking you.
From the sector that I belong to for the last, 42 years, I like to see occupancies go
Most
up
certainly.
and average rates go up, but also rightly so. For the quality of service you provide in general in Asia, and in particular, let's say with our palaces and with the experiences we offer in safaris and some of the most beautiful Taj properties, is still not given a fair treatment on the rate. We're very happy paying 5 times more in, let's say, in New York, or even in the New York in Taj, we get 5 times more. I think it would be unrealistic to expect those kind of numbers, but the rates have a way to go, and they should. See, there were certain iconic assets 20 years ago, they were built for around 100 crores. The same asset, if you had to build it today, will cost 1,500 crores. The rate 20 years ago was around $100, and today is not even 150. So it's a math that does not work together. And it was high time that the rates went up, and they've actually gone up for the sector, as we have seen in all the quarterly reportings from HVS, from Horwath, from the Horwath just came out with their study, and all the events that are happening, all the consultants, advisors, analysts. So everybody's talking about increase in rates, and we have reported in our third quarter 27% increase in average rate over 1920, which means almost like a 10% increase per annum, and that's fine because the inflation is also 7-8%.
Sure. So I heard you use the term "some way to go." You reckon that rate? So people may believe that, hey, at some point of time rates will start coming back because at some point of time demand will slacken if indeed rates go up high. You believe that rates may actually move up from where they are right now.
Because if supply remains constrained,
And
the
you think it will?
occupancies will go up. And if the GDP growth stays as estimated
Mhm.
by the economists for India, the disposable income will go up. The disposable income goes up. Also, the ability to spend will go up.
Sure.
And the ability to spend goes up for the hotel sector, the ability to charge goes up.
Hmm. And of course, you mentioned supply remains constrained. So I'm just asking, you look around you, you are adding some hotels, if I'm not wrong, 13 odd hotels, but look around you India wide, you think supply will remain constrained?
See, it's a very, very interesting situation.
Mhm.
If you look at the budget speech of the Honorable Finance Minister, talk about 50 new destinations or 50 tourist destinations that will get promoted under Dekho Apna Desh. If you look at the new airports being built, so several new destinations are coming up which have no supply. When we add up the total supply that is going to get added in the nation, it might be irrelevant, a part of it, not the full,
Mhm.
because it's coming in new destinations where there is nothing. So you need something to happen there, some hotels to come in. So as long as your major markets, let's say for us, it would be Delhi, Mumbai, Bangalore, Rajasthan, Goa, Chennai, as long as they are Kolkata, as long as they keep performing well because of a strong demand and limited additions to supply, I think the sector will continue to do very well.
Okay. Okay. Very often we get caught up in conversation with a hotel management about average room rates and forget, as I was told by your wonderful team as well, that if you just scan through what F&B is doing to revenues, what other avenues of business, I mean, you have these homestay pieces. Now, you could argue that even they are ARRs, so to say, but it's a slightly different piece than what a hotel room is per se. So can you tell us, um, I mean, the basis obviously will be different, but can you tell us where is it that you believe potency for high growth from where they are relative base exists for the near term or the medium term?
I think again I have to say a very interesting question because for us, 45% of the total revenue comes from non-rooms, mainly from F&Bs.
Mhm.
Mostly 45 to 47% comes from rooms. And if we just get focused only on room and occupancy, we are ignoring the rest of the sources of revenue. That's one. So F&B in India is very strong. People still like to go to hotel restaurants. People still like to do nice weddings. I'm coming back from one today after 2 days in Jaipur. And the wedding season has been extremely strong this time. So I think the MICE component is still not to pre-COVID level. That's your meetings, incentive, conference. So I think it's getting close, but it's still not there. So the non-rooms demand, that is one source, is your food and beverage. The second is your asset management of spaces. Now, if we look at lounges, if we look at our private membership club chambers, if we look at all the business on wellness, poolside, health club memberships, spas, we have 75 plus spas. I don't think anybody I know has 75 plus spas in the category of the hotels that we operate in. So all these products 3-4 decades ago were developed to support your mainstream brand. Now the time has come for the sector to unleash the potential of these brands as standalone business. And that's something which we have been doing pre-COVID, continue to do it during COVID, and are doing it post-COVID. So Cumin, which started as a home delivery, is in food trucks, is getting into kiosks at airport, and is getting into quick service restaurants. Now, we extended Cumin as an example to our Ginger brand. So all day dining of all Ginger hotels will be standardized with the Cumin offering. I hate to say this, but I will tell you that when we started Ginger, we said we will do it like you do it in the West by outsourcing food and beverage. So we gave up the 30-35% because at that level, the F&B revenues is not 45 or 50, or in some of our resorts, it's even 55. So we gave up that potential. Now we have got that outsource into insourcing, standardization, our quality, and suddenly we see a drive in both revenue and our EBITDA absolute terms, as well as margins.
Wow. So I saw this quarter, for example, quarter three, I'm using that as an example, but I'm sure it happened throughout the year as well. Your operational metrics improved quite dramatically. And I use the term very carefully. I don't use it often. So my question to you is, by virtue of the change that you mentioned at the start of this interaction, which is the variable cost versus fixed cost mix, by virtue of the fact that you mentioned that there is a lot more impetus that you're giving to other revenue streams as well, which are ancillary but been a part of this. Do you reckon that these operational metrics, these margins, are levels that you might be able to sustain or improve upon going ahead? And I'm talking about a 5-year view, not necessarily 2-3 quarters.
I personally believe yes. I personally believe it. And
Sorry, I didn't mention ARRs, by the way.
Yeah, I'll give you 3 reasons for
Anji.
it. Number one, we have communicated under Avan 2025, which is our strategic, call to action, a balanced portfolio of owning 50% or leasing 50% of our portfolio, and on a management or a fee-based driven model for the remaining 50%. So number one is operating leverage. Number two is very strong growth. We have communicated numbers which are very different for our organization. It took us almost 115 years to come to 100 hotels, and it took us only 3, 4, 5 years more to come to 200. And today we are at 252 in terms of the total portfolio, with around 185 in operation. So the growth, and a growth on a different business model, and I'm not counting homestays in it, which we have added another 100 in homestays, and what I just now said on quick service restaurants and home delivery. These are all very high margin businesses. So we reimagined some of our brands. We kept the names because those names were very good. Whosoever thought of them did a brilliant job. So Ginger is a great name, but we reimagined Ginger value proposition completely, and we repositioned that brand. We came up with new brands like Cumin and Ama, and we scaled up in the growth part very strongly with the 120 contracts that we have added in the last 5 years, of which 50 hotels have already opened. So when we report our numbers, we have the benefit of the operating leverage because of the hotels we own. When the times are good, it drives your revenue up and profitability. At the same time, we have the benefit of the relatively new businesses, which are small but are reimagined, and they contribute high contribution margin or high EBITDA margin. So they drive the percentage level. And there is one third factor, which is the other one, is continuous innovation. So it's not that now we did this and we stopped there. So we have also reimagined and done a lot of asset management in our existing beautiful assets by renovating smartly. I'll give you an example. 5 years ago, the Taj brand had 31 hotels in operation. Today, it has 75 hotels in operation. So that's almost a 2.5x growth. Of these additions, the 44, 24 came from existing hotels which were a bit run down. So we started on that journey long time ago, and we kept upgrading our portfolio. So when even the Indian subcontinent or India was hit by COVID, our assets in Holiday Village, Fort Aguada, Fisherman's Cove, all these resorts had been renovated and were ready to start contributing positively, and that journey has continued. So the combination of operating leverage, growth with innovation, and not losing sight of high margin business, and the third being effective asset management, has created the impact that you see on our results. And all 3 quarters, Q1, Q2, Q3, have been the best quarters in the history of our company. And I have no doubt the way it is going that Q4 would be any different.
Oh, okay. And what's your internal assessment? I mean, one is, of course, the vision statement that you've given out, but as the base moves up, do you reckon the pace of growth, the margins help you in a big way on the operational front, on the bottom line front, but the revenue front, do you reckon the pace of growth could slow down at some point of time? Is it some time away that plateauing off of the high pace growth that you're suddenly showing in the last, let's say, 24 odd months?
I don't think so because we have 65 plus hotels in our pipeline, and we should open at least 50 of those in the next 3 to 4 years. Now, this is, I'm not adding anything that we might sign today, which could open in 6 months, a brownfield or a conversion. So, even if from 65 only, let's say 35 get built and the 15 others come through this. So, 50 odd hotels in 3 years is a big number and gets us to that 300 plus, which we have communicated as a part of our strategy.
Okay.
And most of those that will open will be again on an asset light model. We will continue to invest both as capex in our iconic assets, in our other brands, but we will also invest in new destinations. We have done that historically. We have done that very well. Even before I entered hotel business, we started Goa with Aguada. So, and we started almost Kerala, and we have now done that with Havelock and Andamans. So that journey will continue, and we're doing it in Kevadia. We're actually doing two hotels, a Ginger and a Vivanta in Ekta Nagar, or popularly known as Kevadia, where you have the Statue of Unity. So I think that journey will continue. It's a part of the ethos of our Tata Group, which has been very strong. And we will be within 6 months' time opening our flagship Ginger in Santa Cruz, right on the main expressway taking you to the airport. So we are very excited that by doing these things, the combination of these things with the help of the, I would say, like commendable engagement, dedication, and perseverance of all our teams and associates, things are happening, and I think they'll continue to happen.
Now, well, I must say, before I ask you the last question, we experienced it firsthand. It was a treat to be at the World Economic Forum at Davos in the India Lounge and see the Indian hotels hospitality, not just for ourselves, but for people across the world who came to the India Lounge and experienced that. So that was pretty fabulous, I must say.
Yeah, but also there is an opportunity out there. See, I got the similar feedback from a lot of government officials, from private sector, from our own Tata Group CEOs, etc. We can plan these events on a larger scale, including with Bloomberg or other, media houses. Why don't we take a larger space, and we are here to service and provide that service and showcase it to the world, and not just do an India Pavilion for food. We can have conference rooms, meeting rooms, camera rooms where you are interviewing people. So I think a lot can be done using the same platform. And with the new India, the way it's emerging, with the new confidence with which the Indians are doing business, and the numbers, I think maybe Davos was having the highest representation from India. I don't know exactly the figures.
It's very high, yes.
But it is quite high, and I've been associated with that event in my previous job, so I did not see as many as you see now. So I think it's a very positive evolution, and such global events, I think we should come together as a team and jointly showcase. And anybody who takes the lead, we are there to provide the service.
Great. My final question, what's the risk to this rosy picture? You mentioned at the start there's a talent crunch. I hear from a lot of people that after what happened in COVID times and the uncertainty that got caused around earnings and livelihoods getting impacted, as you said, are people, the industry may be a high growth industry, will need people because it's a people's industry. What if there is not enough talent willing to join this space because of the uncertainty or the perceived uncertainty?
It would be fair to say that what you're saying is to some extent true. Globally, a lot of people, when shut down airports and shut down travel and shut down, we call use the term lockdown happens and hotels are shut. A lot of people need to find some other form of livelihood and migrate to other sectors. But there are also people like me who have only done this for the last 40 plus years, and we have taken it as a responsibility. And, collaborated with institutions like CII and committed to skill up to 100,000 people by 2030. And we have already opened, committed to 16 skilling centers. The last one was just signed last week in Lucknow. So we are doing a lot of skilling center, and you can be sure that 100,000 people is not what we need. It's for the sector per se. So I remain, optimistic as always that this too shall pass, and the excitement to work in this sector is possibly the highest. And people will come back, but of course we have to learn to treat people with empathy and care, because if you don't treat people with empathy and care, they will not do the same with your customers, and that's where we will start losing the touch of Indian hospitality.
Okay, before we wrap this up, a quick fun question. Any small place in India that you recently seen, visited, thought of opening a property or otherwise, which you think people should consider when they are doing the travel plans?
Wow. Any small place in India which I have...
Not the popular destination, which is what I'm trying to say.
Yeah. See, instead of saying it that way, I would just answer your question, but in a different way.
Sure.
Because this is what we have communicated. And what we have communicated is I see Northeast as the next high growth region for India. With the Seven Sisters, as you call it, from Sikkim till Arunachal. And we are opening hotels which are in very fascinating destinations. So there is a Vivanta opening coming up in Tawang in Arunachal. It could be doing experiential stuff in Kaziranga. There's not much that exists. And India is also a kind of a market where if you come up with a good value proposition, the good supply, the demand will follow. The book version of first go, let's see how much demand is there, then you decide what to build, is not always relevant in markets which are really, not developed to that level, but offer a very high potential. And I very, we just opened a Vivanta in Shillong, and we have decided to do 25 hotels over the next 3 years to get our portfolio to total of 25 in operation or under development, besides the homestay in the Northeast. And that's quite a statement. But we've officially communicated it and we stand by it.
Well, we wish you all the best for that, and wish you all the best for the quarters and the years ahead. It's lovely enjoying the Taj hospitality out here and across the world, and keep that up.
Thank you. Thank you very much for your time, and thank you for coming here and doing this session with me.
In this wonderful suite at the Taj Mahal, Mumbai. Thank you so much for talking to us today. Viewers, thanks for tuning in.